Big changes coming to mortgage insurance. We're going to talk about those changes, when they come into play, what is mortgage insurance, who has to pay it, and how to avoid it right after this. Hey there, this is Ryan Skaggs, and this is the Mortgage Minute. This channel is dedicated to everything mortgage, real estate, and interest rates, and we're going to start with those interest rates. So market update. Not a positive look right now. We've had a trend of interest rates moving up over the entire month of February. So higher than expected inflation numbers has continued to push rates up. I've got a link to the average 30-year fixed according to Freddie Mac just below. So check that link out. You can kind of see the trend of January coming down, February coming back up. If we can get a hold of that inflation, we're likely going to level off and or maybe see rates come back down. If we can't get a hold of those inflation numbers, or the inflation comes up even higher than we expected in the future in these coming months, we're going to likely see rates continue to go up. So I can tell you in the individual kind of Chicagoland metro market, which is where I'm at, it is getting pretty darn hot. We are extremely productive right now from a team-wise, and it's starting to be multiple offers again. So that's your brief market update. Again, that link below to Freddie Mac's average 30-year fix. While you're down there, hit that like button, hit that subscribe, and click that bell icon to be notified as I'm putting out weekly videos on the channel. I would be forever grateful for that subscribe. It's absolutely free, and I know over 80% of you viewers out there are not subscribed. So we're gonna talk about mortgage insurance. First of all, what is it? Anytime you have less than 20% down, you're likely going to have some sort of mortgage insurance, either on the forefront that's being shown to you as the borrower, or on the background that the lender might be paying for, or kind of some other non-transparent behind the curtain type thing. Essentially what it is an insurance policy that protects the end investor, the lender, right? It does not protect the borrower, but it does allow you to put less than 20% down. So it definitely serves a great purpose. You can put 5% down, have mortgage insurance, and then it's able to be sold off into the secondary market with this extra piece of insurance on there. How is it calculated? So I'm gonna do some math here for you, and I'm gonna kind of show you what it looks like. We use a factor or a percentage of the loan amount. And that is going to kind of give you an idea. In this case, I'm going to use a $300,000 loan. We are going to look at it from a 0.15 factor. That would mean you have a pretty darn good credit score, not the best ever, but pretty darn good. And you're putting between maybe 10-15% down at this 0.15. So in this case, you're going to be able to see how much the annual mortgage insurance is here, and then you're going to be able to see how much the monthly mortgage insurance here, because we're just going to divide by 12. So hopefully that all kind of makes sense to you. So again, how it's calculated is just a factor on the loan amount, and that is based on credit, debt to income ratio if you're self-employed, so many different factors on that mortgage insurance. Now, while we're talking about how it's calculated, and this is going to be number 3, is that since COVID, where they actually kind of changed the philosophy around on how they calculate mortgage insurance, if you have good credit, mortgage insurance is a lot cheaper than what you might be thinking. So reach out to a lender, put a message below, would love to connect with you. But mortgage insurance is a lot cheaper than most people expect when you have a credit score, say, above 720 or so. People just expect it to be much more expensive than what it is. Now, let's get into the big changes as well. So FHA. So Federal Housing Administration, if you're thinking about an FHA loan or need to do an FHA loan, that's a whole nother video, a whole nother topic. They're changing their factor of how much it's going to cost for mortgage insurance in the future. Again, I'll put up a quick what was before and then what is after. So you can see if you put 3.5% down, 0.85 was our factor. That's going down to 0.5. Now, what does that actually mean to you? So if you are looking at a property today, let's say that's $300,000 and you're gonna have an FHA loan, put 3.5% down, you can afford $10,000 more to have that exact same payment just because of this new policy change from the government. Because they're lowering down your mortgage insurance on a monthly basis, you can now afford more, or if you can afford the same, you're saving money. The average homeowner, average buyer that would be doing a loan like this in this example is saving roughly $800 plus per year. So definitely going to help in affordability It's not going to help on our low inventory that we have. We just need more houses out there because the demand is still pretty darn high. So I'm going to put a couple links below to a couple articles that kind of run through this as well if you want some more information. Let me know what comments you have. You know, if you want me to run a scenario, or if you've heard good things, bad things, or indifferent. And last but not least, click that subscribe. I'd be forever grateful. So stay safe, and we'll see each other again very, very soon.